Mr. Mark Selby, hello and welcome from wherever you are. Where are you?
Mr. Matthew Garden. I am sitting in the Eleuthera in the Bahamas. I figured out if I'm going to be stuck behind a screen, I might as well be in a place that's warm and sunny than being stuck behind a screen at some place that's cold and snowy. So down here for 10 days.
I appreciate you not doing that from the beach and really, really irritating the rest of us. We're just so jealous. Little toes tickling the water. None of that. I look forward to hearing all about it when you get back. But look, I needed to phone you because there is a molecule crisis. What do we do?
I know that actually was quite interesting. Jeff Currie, I think he said he was at Goldman for 30 years and said we're running out of everything basically on Bloomberg. I think he's been chief strategist now for about 20 years. When I was head of commodity research at Inco, had a chance to meet with him several times. Goldman oftentimes talks their book, but I think it's important when commodity analysts, who generally like to be within 5% of whatever the consensus is or 5% of whatever today's price is, when they start to venture way out on a limb, you should really pay attention. Because again, they don't do this very often. And, to me, he's really highlighting, we've talked in the last few shows about, sort of the disconnect between the commodities and the equities. What you also see, and this is where it's sort of almost at a two-level disconnect, is you see the disconnect between the actual underlying data and the commodity prices, and then the commodity prices, and the equities. And what he's really focused on, is that first disconnect between the underlying data and where prices are now.
So his question for you, because I think it's interesting when Goldman's talk, people listen, right? Because they're just a money machine, right? So obviously Curry's saying something like that, is on Bloomberg TV, a little bit of arm waving and a little bit sensationalist in a way, but they don't say things like this lightly at the same time. The market takes notes. So that's good news. Do you think that this is the beginning of and we should say, he wasn't just nickel. He was talking oil, gas, copper, aluminum, everything, right? He was talking everything. This is a move towards metals and minerals and mining more broadly for them. But do you think that this will also drive people who are coming out of technology, apart from maybe the metaverse, but things like Facebook, even Google, Amazon, they're being hit at the moment. There's a little nervousness there. Do you think people will look towards our little industry a little bit more favorably? Do you think people will try to want to understand what it is in terms of the opportunities ahead?
Oh, for sure. And the key there is, there's, in terms of global asset allocation, there's really, a very small percentage that ends up being allocated to commodities. And so, again, in those mid 2000s where, everything just seemed to, go up on a rope for a while, that happens when, people decide, okay, we're going to allocate, another 1 or 2% of the global mix gets allocated to commodities and resources. And it just feels like a tidal wave of cash coming at the sector. And again, these guys do not do this lightly. So, they're looking at things like, again, at the time at Inco, we had access to all of the top, economists and strategists and so forth. And I remember very vividly, just after I started in 2001, very simply, if you just took the S&P 500 sectors by decade, again, very, very often the top performer was the worst performer, and vice versa. So, again, after the 2010s were pretty brutal decade for resource stocks, number one, that is sort of longer term trend number one that should be reversed. Longer term trend number two is, we came out of a period of underinvestment. The big mining companies blew their brains out. 2011, 2012, massive capital overruns. Shareholders were, beating on them left, right, and center. And they're like, okay, we're not doing big projects anymore. We're really scaling that back. So you saw the mining industry really scale back the amount of investment that was going into the space. Now, the Chinese more than stepped up, with taking a lot of marginal resource within the country and elsewhere to help provide some of that incremental capacity. But then I think the third trend here, and something I mentioned before, is that in a lot of commodities, the Chinese were sort of were the Amazon of metals. If you order it, it just magically pops up. They build the capacity in 6 months, they start producing, and the stuff shows up at a lower price than it was the year before, right? And that, over the last 12 months, the shift on squeezing energy prices, these squeezing environmental regulations, has really made that sort of Amazon click and you get it factor in the Chinese supply chain really disappear from a metals perspective. So, those are three big headwinds that are not going to be reversed anytime soon. So, it's those kinds of things that I think, they're looking at.
Absolutely. And I think, while the FANG companies and FANG shareholders are grinding and gnashing their teeth, I think there's a real opportunity here for retail coming into this space, but they're going to need to get educated real quick. What's the best way for retail to play this? Follow the big money. Like, I'll give you an example. So yesterday, I spoke with one of the kind of bigger funds in the uranium space. They've did an ATM. I think they've had a recent inflow from institutional of about $160 million over the last couple of weeks. They expect more institutional to come through as they buy into this thesis. So with people like Goldman's buying into the broader natural resource thesis at the moment, how do you think retail play this? Sit and wait, get in early, be contrarian, be cautious. What are the lessons of the past?
Yeah, and I think one, do your work. You need to be personally confident that, you believe in the trade, because, as we talked about the commodity equity disconnect, it's never a straight line up. You're going to see these periods of sell-offs. And, if you don't have your conviction, you'll end up exiting, and then, things will turn around a month later and you'll be left, leaving a huge amount of money on the table. So, do the work to get your own conviction. I think number two, again, own assets across the staging. So basically producing, developing, exploration. So you're not betting on a certain sector, a certain subsector within the mining industry, having all that cash come, because sometimes it might just come into the producers and not trickle all the way down. That's been an issue to date, is we have seen some bumps. The cash flowing companies get new capital, but it's not nearly as much as historically has ended up on the developer explorer side. So it's good to, again, pick good teams with good assets, and make a handful of good bets that you've got some belief in. And the key thing with these things is, when you get these shifts, they do not last forever. So if we just go on for like another second here, is this kind of data to commodity price disconnect again happened during that China super cycle. 2003, 4, 5, we were lucky at Inco because nickel went first. That was the first metal to really break through prior highs and get there. But the other base metals, copper, zinc, had still been trading, close to some of their historical ranges. But China was consuming everything, not dissimilar from Mr. Currie's statement here. And so you could see it's very clearly, there was a massive deficit in copper. There was only so much stock on the LME and COMEX at that time. And, you do the math and we're going to run out of copper at some point. And prices just stayed at that $2, like around that $2 level, and just did not really break above that. And in fact, Phelps Dodge, which was one of the world's largest producers of copper at that time, they did a £1 billion hedge at $2, literally about 6 weeks before prices ripped in the span of 6 months up to $4 a pound. And which is where they stayed until, plus or minus around that, up until the global financial crisis in 2008. So, again, I'd love to point to a certain group or people or companies' behavior to look at, but do your own work from a bunch of sources and have your conviction. Because again, if you believe it, it can stay disconnected for a very long time. Copper was like that. The same thing with zinc. Zinc stuck at $1 a pound for a long time. Inventories were going next to nil. It was about a year after it happened with copper. And then all of a sudden, zinc was $2 a pound. So, that's, it might be painful for a year, but if you've got your conviction, you've done your work, and in this kind of scenario, this will play out.
It's interesting what you say there. My takeaway from that is, Gordon Gekko wasn't right. Don't be greedy. You've got to look at your risk profile. So, from explorer, developer, producer, you're going to have to mix the portfolio up, be a little patient in terms of your expectation, in terms of the types of returns, the length of time that you'll need to be invested to do that, ride a few bumps along the way. Is in simplistic terms. is what I always advocate. And I think what we just said. I'm also very cognizant that you have a hard stop because you need to go pick up a rental car to traverse the island. Should we talk companies? A little bit of drilling news?
Just one more point on that front, even
sure.
with my heart stop, is again, the key thing with these are, when you get to a point where the price is coming well off the cost curve, so prices are off the cost curve now, and what Currie's talking about is, and again, the same thing happened in 2004-5. You're going to move off like a multiple of the cost curve, and this is where we are in lithium today. That is not sustainable. Again, lithium prices are going to settle out in a range. I can't tell you where at this point in time. But when you're buying into a metal that's already made that 3x, 2x, 3x move off the cost curve, you have to be very cognizant that generally either the cost curve moves up to meet the price, or the price comes down. The price comes down to meet the cost curve, and it's usually the latter. And it comes in the form of either a new source of supply that people didn't expect. That was nickel pig iron, and nickel in 2007. I made a huge amount of money shorting nickel in 2007-8, because again, it was very clear, that was the case. In something like lithium, there's a whole pile of work being done on direct lithium extraction. The Chinese are always good at taking some kind of resource and turning it into a usable product somehow, some way. And again, these kind of prices will generate a lot of cash for people to be able to figure that out. And again, in something like zinc got it, finally exploded to $2. You made a lot of money there, but it only stayed at $2 for 2 quarters. And it only stayed above $1.50 for 6 quarters because there's a ton of small zinc mines in China that came online. Zinc's main use is galvanized steel, and it's a coating on galvanized steel. So they got very good at thinning that coating or mixing it in with a little aluminum. And then all of a sudden, the market was back in balance again, and poof, the big rally's going. So, again, if you're trading a spike, make sure you trade the spike. Don't start, because as soon as the spike happens, there'll be all kinds of stories about how this is different this time. This is going to be, it's a new paradigm, blah, blah, blah. That's when the not the Jeff Curries of the world who are talking about it, but when Joe, commodity analyst, all of a sudden gets excited and is talking about a new paradigm shift in their note, that's when you absolutely hit the sell button. So good advice, worth reiterating, and we will again. Let's talk company news. Let's kick off with Talon Metals. So Talon, great set of drill results. Again, unfortunately, like everyone else in the industry, assays are miles behind. So you're forced to talk about types of mineralization that were there. And again, they've got this new area that's outside the existing resource, the CGO area. And again, getting some they've stepped it out another 50 meters, getting lots of 10 to 15 meter intervals, which is a very, very good a width to have. And it looks like there's another thinner sort of 4 to 5 meter width structure that's showing up parallel to that one that's there. Again, no nickel grades, but they talk about whether it's massive and disseminated. This is the I know retail investors always want a new exploration results and new step outs, but to produce a resource, you need to do a lot of infill drilling. So that's the nature of the beast here. But I would say these are very solid results. Brilliant. And okay, we've been following them for a while, so that's obviously good news. Continues to be good news with their partnership down there. And Magna Mining. Now, this is a company who I think are going to come on in the next couple of weeks. We interviewed them a couple of years ago, and obviously things have moved on a little bit, and they seem quite keen to come and talk about it. So what do you know? Yeah, so Magna Mining, again, very experienced team. A bunch of the people there were with FNX Mining, which was one of the big success stories of the 2000s. They picked up basically some properties that Inco was willing to discard. Which was a giant mistake on their part. And, they turned it into a couple mines, restarted it, a couple mines, made some discoveries. And so, there's a number of people who are around that story who are involved here with Magna. They picked up the Shakespeare mine. It operated briefly in the early 2010s, at kind of today's nickel prices. So it's a lower grade, smaller, but open pittable deposit just west of Sudbury. And so they announced that we talked last week about the MOU they had with Mitsui, which is a good sign that you're talking to real industry players who are willing to help get the thing financed. So they put out their feasibility study on not only restarting the open pit, but building a milling operation that's there. So again, this is not going to be a huge mine, but you're looking at kind of 12 million pounds of nickel, plus or minus over existing 6-year mine life. But over the past year, they've also announced some pretty decent results, that should have some extra resource that probably puts that out at least another couple of years, because it has nickel, copper, and PGMs. It ends up at cash costs, very, very low cash costs. And so, yeah, this is really, they had some permits from the prior work. I think they've worked on refreshing those permits. And so, there aren't many new sources of nickel that can actually come on in the next few years. And this is one of them. It's, it's not going to change the supply demand balance, but it's something that could, get to cash flow. I think one thing that they'll really need to think about is, do you bother building the mill, or do you just, mine and ship ore, and maybe upgrade it a little bit or sort it and then ship it to Sudbury? It's a sort of a chicken egg. You obviously leave lots of money and value on the table. It's spent on trucking ore, but if you could get into production sooner, what's sort of the better trade-off to do. So, and which I'm not sure they've put this forward, so that's a real option now and gives them some leverage versus the Glencores and the Valleys of the world who are desperate for feed at this point in time. So it's a much different game for them than 2010.
Exactly, and I think that's a great point. We spoke with a company called Allegiance Coal yesterday, and we were talking about the Rios and the BHPs. Who filled a role, they'll be producing 3-4 million tons from one asset. They've left that game, and now lots of small companies with small assets are having to kind of fill the gap for the coal demand. And we've talked say with John Baglia on the uranium side, these companies need to know and understand how they fit into the ecosystem, where they fit, the price points, obviously clearly the economics, but it's a very sort of fragmented market at the moment across multiple commodities. You and I have talked about the need for scale, and obviously you're doing that with your project, but we kind of need more of it, more often. And as Goldman said, this is a molecule crisis. Yeah.
Oh no, one of the biggest, when talking to investors, they always talk about, I'm struggling to find good nickel stories, and again, with that decade of very little capital actually coming down to the explorer developer stage, across a range of metals, we really don't have, the same set of, you've got 10 or 15 companies, at different stages of production, that the market's paying attention to, and, that create real investing opportunities, for investors, of every size. So, I am really, really hoping that these guys keep pushing forward and they're able to get into production, because the thing that would benefit all the nickel companies is having another nickel company for investors to invest in, so they can afford to spend more time on the sector as a whole.
Yeah, no, I agreed with that. I thought it was the beginning of something good in terms of bringing people into natural resource investing. Okay, FPX and Poseidon Nickel, a little bit of news out of Oz there. So what do we need to know?
Yeah, so we've got some sulfate production. So FPX is talking about looking at a sulfate scoping study. Again, they have a very, very high grade concentrate. The aurorite mineral that they have is a 70% plus nickel tenor mineral. And so they can produce, a very, very high grade aurorite nickel iron concentrate that, can be basically directly processed by a range of different industries. I think, this is, more marketing than anything. It's sulfate, again, it's a horrible product. It's 22% nickel. BHP started with a 99.8% feed for their sulfate plant and struggled to make an on-spec product. So I know retail investors, want this. The industrial reality of it is junior mining companies should not be deploying capital on that spec, on that part of the supply chain. Let one of the other battery guys come in and do it. Now, again, you need to demonstrate that the thing works. I totally get that. But again, please, don't think all these companies are going to be producing sulfate at a range of different locations, here, there, and everywhere. So again, their concentrate it's a beautiful beautiful concentrate that can go anywhere. And so again, it's kind of sad that we have to do this for the retail market to kind of, and I shouldn't say just retail. There's a lot of institutions that get sucked into the same thing. So I think it's good to show that it works. It will work. But I hope to God that they actually don't build it. So
yeah, I mean, it's a great point that you make here, because you see companies who want to deliver scale but can't via the assets. They try and move downstream and capture some of the value downstream, and that usually involves having to bring the technical skills in house, or at least partner with someone who can potentially deliver the technical skills in house. And it's almost I kind of like them to just go back to basics. I tell you what, it's like, do some M&A. Do not try and crack this code. It could be an expensive mistake. And, we've seen enough examples of that. So I don't know enough about this particular instance. I'm listening to what you're saying, but more broadly, when companies try and move downstream, I get a little bit nervous, because I think there's going to be a lot of money, a lot of distraction, and not necessarily all of the upside that they think coming down the line. So
yeah, I think Martin's a smart guy. So I'm sure he's doing this just to be able to clearly tell the market, look, we did the work, we shows that it works. It makes a lot of money. So we can easily go find somebody to help do that with. Is what I'm hoping it's for. And Poseidon, they're talking about. They're fortunate. There's a group that's looking at making a precursor battery plant in Kalgoorlie. And so, again, they're doing the work to show that their concentrate would be a great feed into that particular facility, which, again, nickel concentrates with irons is something those plants don't like, but, it's doable. So
right.
you can get rid of it. And so, it's good to see more of that. And as I said, that integrated, concentrate into a precursor plant that's going to pump out precursor, is ultimately the way I think this market's going to evolve going forward. So.
Okay, brilliant. Well, look, Mark, there we go. We're up against your hard stop time. Appreciate this. You better go pick up a car, explore the island, have some fun, and we'll see you next week.
Sounds great, sir. All right. Thanks, Matthew.